Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Masser and Tim Stenevec on Bloomberg Radio.
We've been all in on Apple today. The company out with biggest product launch of the year, the iPhone 17, a skinnier Air design. It improves durability and camera tech. As far as prices go, $799 is the starting price of the standard phone. The new Air version will cost $999. The Pro is going to go up by $100 with twice as much storage. I want to bring in Dan Ives. He's global head of technology research at Wedbush Securities. He's also chairman of Acre Holdings. Soared over 3,000% after announcing a plan to buy
in the news just a little bit
by OpenAI's Sam Altman. That was yesterday. Dan's here on site at Future Proof in Huntington Beach. We're going to talk about Acre Holdings in a minute, but first I just want to get your reaction to Apple, because you actually, I saw you were on your laptop, and then I got your most recent Apple note. While we were doing our interview with Barry, you just sent out a new note. You're maintaining your price target on Apple. You and the team at Wedbush estimate there are 315 million folks out there who are ready to upgrade their iPhones. Is the 17 going to get them to upgrade?
Look, I think it's going to move the needle. I mean, I think especially in China, there's definitely what I'd call pent-up demand. I think street numbers continue to be pretty conservative to maybe low, and I think that's a great setup. Look, the reality is that this is not going to be a super cycle. There's nothing here that makes you think that this is going to be the game changer that everyone's been waiting for. But I do believe, given the install base, given some of the tweaks here, and ultimately on sort of the second half of this upgrade cycle, you will have an AI-driven ecosystem. I believe it will be Google Gemini. This could be a sneaky upgrade cycle that I think surprises investors on the upside.
What do you mean?
Because right now, expectations, New York City cab drivers bearish on Apple. And I think that what I like about the setup is it's kind of left behind. Now, a lot of that's been self-inflicted, because every Apple event feels like I feel like Michael J. Fox and Back to the Future. So they continue to be left behind AI. But now with the Google DOJ issue in the rear view, they will double down ultimately on that Gemini partnership. And when you look at the install base, I think Street is underestimating what numbers look like for iPhone when you look out over the next 6, 9, 12 months. And I think in big tech, I view Apple from a sentiment perspective relative to where I viewed Alphabet maybe about 6 months ago.
You, in your note ahead of the launch, called Apple's AI strategy, quote, invisible. You said the elephant in the room is the black over the stock. AI's invisible, or Apple's invisible AI strategy. Did you get any more information today at the launch about its strategy?
I mean, I think fundamentally they're keeping it close to the vest, right? Like, in other words, like, it continues to be that black cloud. I think they're waiting for ultimately what's going to be Gemini, because I think they had a choice: either go down the route with Perplexity and ultimately look to acquire that, or if it was a favorable ruling, then the candlelight dinner with Google and Sundar could ultimately start again, and then you could actually double down that partnership. And that is, I believe, the direction. But look, Tim, it was a black eye moment a year ago when they laid out the AI strategy. I mean, it's 95% that had a backtrack on it.
Well, now they've lost a lot of the senior executives that were working on that to Meta platforms.
And we've talked about there's a better chance of me playing Ryder Cup Bethpage than any internal AI strategy happening at Apple.
But is that such a bad thing? And this is one of the things that, Dan, we talk a lot about, that maybe Apple's just kind of watching. There's a lot of money sloshing around trying to figure out what ultimately are the standards, the methods, the companies that really dominate, right, in terms of AI kind of protocols. And maybe Apple's like, I'll just watch, and then we'll figure it out. Is that bad?
I think it's bad. I'd compare it to like Saturday night in New York City. There's a restaurant where there's one person in there at 8:30. Like, oh, they must know something everyone else does. I'd rather go to the place where people are lining up outside. When it comes to ultimately AI, time's not on their side. Look what OpenAI, look at Meta, wartime CEO, look at Microsoft, look what Google's done. That's why it's an all-time high. So I do believe Cook's recognized it.
Mm-hmm.
But the problem is that now it's a go time moment when it comes to AI. And that, look, we've talked about it. That's how you get to $325, $350, $400 stock is AI, relative to right now Apple. They're kind of on the outside looking in of that AI party where it's still 10 p.m. going to 4 a.m.
Everyone wants to know about what the heck is going on over at Acre Holdings. You're chairman of this company now. I think it took a lot of people by surprise. It's a crypto treasury firm, and for those who aren't familiar with the way this works, it's a Michael Saylor strategy, but with a different cryptocurrency. This is WorldCoin, backed by Sam Altman, eyeball scanning stuff. What is going on here?
So I wouldn't have done this as chairman if it was just a regular token DAC strategy. The reason I did this, it has to do with Sam. It has to do with my view World is going to be a de facto standard for identification, authentication in terms of human proof in AI world. This is much more of a tech infrastructure play than what I'd say a traditional crypto play. So obviously the reason I'm so excited about it is really this is going to become, I think, a huge part of the story and the narrative. It's really an intersection of AI and crypto.
Explain that, Dan, though.
So what that means is, as Tim talked about, it's iris scan, the orbs.
Right.
Going forward in the future, especially in a robotic world, bots everywhere, you're not going to be able to just identify through a blue check. It's really going to be iris scanning. What they've done already, 15 million humans on the platform, I believe going to about 100 million over the next year. That's going to be a form of identification. That's probably the most privacy lockbox out there, and it's secured by a token, a world token. So my view and our view as a team, this is early days in terms of where this is all heading, and that's why we want to do the strategy now.
What's to prevent somebody else from doing the same thing?
They're playing a different game than they're NVIDIA in 2022. In other words, relative to what Sam, Alex, and the team have built out, I mean, from an infrastructure and authentication perspective, they are, I think, miles ahead. I don't see anyone that could catch them. That's why we bet on World as part of the Acre strategy, and obviously having someone like Tom Lee and Bitminer, huge, big investor, that's another support that we're so excited to have.
You've also got an ETF that launched back in June. It's the Dan Ives Wedbush AI Revolution ETF. It's up 16% since launch. It's outperforming the S&P 500 and the NASDAQ 100. Broadcom, Google, NVIDIA, TSMC, Apple, they're the top holdings. Somebody watching right now might be like, okay, he's got a clothing company. He's chairman of this crypto treasury company. He has his day job at Wedbush. How am I sure that he's going to manage this ETF and have the time and resources to manage this ETF in my interest?
I think that's a great question. I'd say when you think about my chairman role, it's all related to AI and the infrastructure. In other words, this is interrelated to my view of where the AI revolution gets built out. And the reality is that 95% of my time is spent, 3.5 million air miles the last 25 years. I think what's enabled to distinguish us is feet on the ground, talking, whether it's private, public, partners. And really, I think that's how investors have grown to.
Do you add Acre Holdings to the Ives ETF?
No, that would be it's a total separate operation.
How do you keep firewalls between it, though?
Yeah.
Like, there's going to be people who are saying, yeah, of course Dan's going to talk up that he loves Alphabet and that he loves NVIDIA. I mean, he's got an ETF. Like, how do we,
on the ETF, and that's
like, we lean on you for,
and remember, the
transparent
ETF,
views.
and part of how investors know us, the ETF is all based on our Ives AI 30. It's all based on our research. So the reality is, I think part of how we've gotten so, I'd say from an investor perspective, we've had massive, I think reception for the ETF is because it's our 30 names that ultimately we view as the winners, and we change that every quarter, and that's, I think, you talk about ETF, what it's based on. It's all based on the research, and got everyone here that knows Dan Ives, they know, like, feet on the street, not sitting there in some Peter Millar 15th floor of a New York City office building, and the only time you travel is 2 times to San Francisco.
Yeah, you just got back from Australia.
Yeah, so I literally landed here from Australia.
What were you doing there?
Yeah, so part work, part pleasure. So it was fun because, look, I mean, when we talk AI revolution, like in Sydney, in Melbourne, packed meetings, because the reality is that this is not just U.S., and that's why I spend so much of my time traveling around the globe.
What might be the irrational exuberance part of kind of the trade today, or the tech trade, or the AI trade? And just got about 30 seconds. There's got to be some fluff out
Just
there.
because you say AI 40 times in a conference call doesn't make yourself an AI name. Look, just because, like Tim, he was wearing an AI shirt, because he says it 15 times and says Tim on the back AI, it doesn't. My view is you have to distinguish the winners and the real ones from the fakes. And that's the reality. And look, that's what we spend all of our time doing.
The one company you're most bullish on right now, public company.
Messi of AI, Palantir. That's going to $1 trillion next 2 or 3 years. And I always say the haters hate it at 15, despise it at 80, say it's super expensive at 150. They'll be saying the same thing at $1 trillion.
Yeah, it's a company we've talked a lot about, I would say, in the last year and then some. Dan Ives, thank you so
Thank
much.
you.
Always appreciate it. Global Head of Technology Research at Wedbush Securities.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Jennifer Grancio is back with us, global head of ETFs over at TCW. They've got more than $200 billion across investment solutions as of the mid of this year, midpoint. ETF platforms have more than $4 billion, a lot under management. They see a lot of flows. We want to remind everybody, too, Jennifer, the former CEO of the impact investment firm Engine No. 1, which took on Exxon. You're going to be iconic forever. This is going to go with you wherever you go, because it was really significant.
I think also you joined us at Milken during that time when you guys were in the midst of that, and that's where sort of like I still know you from, but I think people still know you from that, as Carol mentioned.
Yeah, I mean, Engine No. 1 was a moment in time where I think we had just started to think about energy transition at a very big level. It's not just green, it's brown, and that it was going to require so much to move the world towards better sources of energy, electrification, all the power we need for reshoring in the U.S. So, yeah, that was a great moment in time. And then we folded in a lot of the work we had done there into TCW.
Well, talk about what you are doing, because energy is a big theme in terms of investing here for you guys.
For sure. So if you think about the world today, as much as it's volatile and we're never sure exactly what's going to happen or how things are going to play out, if you think about TCW, we started as an equity firm, and then we've got a great public-private credit business. And so on the equity side, a lot of what we do is fundamental, concentrated portfolios that help you diversify from the index fund and the direct indexing you have at the core, because the market is broadening. And we have a huge opportunity as investors to actually take advantage of how do you profit from the fact that we're seeing different sources of energy, and we have a huge demand for energy for AI and data centers, but also for the reshoring of manufacturing.
How do you do that in an environment where the administration, depending on who's in the White House, changes their view on the future of energy, like does a 180? I mean, you have the president wanting to, and actually doing it, trying to cancel offshore wind projects, and really anything that isn't oil, it seems like he's not interested in, save for nuclear, but that's a bigger time horizon.
Yeah, but that's how we think about it. So from a TCW perspective, we've been investing in the energy and power transition. We do that through the ETF powered PWRD, pardon me. But when we think about that, that's a very long trend. So that's over decades and decades. And so the way we think about it is we, as managers, want to invest for you so that we're paying attention to one administration to the other and what happens. And there will be some changes. But if you think about the changes in the traditional brown so that they can electrify and be more productive in a market like the Permian on oil, that's really important. Nuclear is incredibly important. And then what Trump said on actually supporting more nuclear, yeah, it's a long run game, but that's great intermittent power. So we like to think about it very broadly, and it transcends administrations.
But does it mean you ignore wind and solar?
That can be part of our portfolio as well. We're looking at things that from a very long-term perspective will make sense.
And you think even though wind is under so much pressure right now, in a different administration, it could come back?
It will be part of the solution. It's not the lead place to make money in the next couple of years, and we're active managers, so we can take that into account in terms of the way we manage the portfolio.
Where is money going across your platforms? Where are the flows going in? Where are the flows coming out?
Yeah, we would see if I answer it maybe at an industry question, and then I can talk about TCW. We see active equity is tough. So in active equity, investments are very selective. So what we're doing in active equity, products like Powered or AIFD for AI, they're selective. They're meant to be complementing to big index holdings. And on fixed income, like a lot of money continues to come into fixed income and continues to come into active fixed income. We're also big in private credit, not in the ETF space, and products that are appropriate there.
Yeah.
But both fixed income and private credit are probably the places we see the most money coming in.
Really? Not surprising. It feels like everything is private credit. I mean, I don't like. How do
you? It does, but on the other hand, it's early. So if you think about the portfolio, and if you think about it, biggest institutions in the world, they're invested in some kinds of private credit, but they're looking to get into private ABF because it's diversifying. But in wealth portfolios, if you think about the average investor or registered investment advisors, they're looking at how to take advantage of returns that can be like our core plus income ETF Flexor. That's returning almost 7% with over 5% annual yield. That's very attractive. When you move into safe, controlled, careful private credit, you're still picking up multiple percentage points a year. So people should do it carefully.
Yeah.
But it's a big opportunity.
Do you see that opportunity continuing to grow in a weakening environment?
We do. It's if you go out and you survey, there's a McKinsey report that just came out surveying institutions and wealth. And private credit by far is the place that people are most interested in, most increasing allocations in.
What confidence do you have that we have the right regulatory oversight on this? In a world where private credit there is a lack of transparency, and people maybe not all investors understand that it's not liquid, like a lot of other investments.
It's the right question, which is from a responsibility perspective as asset managers or for wealth managers, we should always be in a dialogue with clients on do they understand illiquids. When you do a semi-liquid product, for example, for us, we have things that have many, many year, 5+ year drawdowns. That's not a liquid product. We wouldn't tell clients that that's a liquid product. In the asset-backed finance space, we have an interval fund, but the loans there are getting turning over within 2 to 4 years. So there's a little bit more liquidity there. Okay. So I think we'll watch the regulatory space, but investor education and responsibility by the managers it's critical.
So when it comes to private credit, you're looking for things where it is 2 to 4 years that they're turning over. So it's a little bit more liquid.
That's a little bit more liquid. And so if you think about private credit in the private securitized or asset-backed finance space, the loans are self-amortizing in 2 to 4 years. That's a space we think an interval fund makes sense. We manage an interval fund there. There are other places where it's just not that liquid, and that should be a private market product.
Still a lot of interest in AI and the fund that tracks that?
A huge amount of interest in AI, and I think everybody's interested in, one, what's happening with AI, who wins, what happens, but people are also looking at how to invest in it. So at TCW, we manage an ETF AIFD, which is investing very broadly in AI. And that's an opportunity to take advantage of, yes, it holds NVIDIA, but it also holds Broadcom and other companies that are benefiting and early winners in the trade.
When you come to an event like this, I mean, is there a narrative you're picking up on that might be surprising? I'm just curious, just got about 30 seconds here.
I think from this conference, which is full of wealth advisors, they are trying to figure out how does artificial intelligence affect their business? How do they get smarter about it? And how can they adopt new outsourcing and new technologies so that they can spend more time actually serving their clients?
Which is a great thing. More time with the investment advisors. Always good to get more time with you. Thank you so much.
Thank you.
Always find it. Jennifer Grancio, she's Global Head of ETFs over at TCW, joining us on site at Futureproof.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
This is the Bloomberg Businessweek Daily podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Carol Massar, Tim Stanovic live here at Futureproof in Huntington Beach, California. Well, our next guests help others manage their money. They are content creators at the same time. With us here at Futureproof is Doug and Heather Bonaparte of Bonafide Wealth. Doug is founder and president. Heather is director of business and legal affairs. Doug is a wealth advisor. Heather, a former attorney, corporate attorney, big time in the insurance industry. And the firm has about $100 million in assets under management. Nice to have you here. I know it's busy for you. Hey. You've got a lot going on. Your website, now it's a wealth management firm built on unprecedented times. Walk us through what that means, Doug.
Yeah, absolutely. So, you look to older millennials like ourselves, the geriatric millennials, if you will. Right?
Speaking my language, guys.
Yeah. We start our adult lives and our careers in 2008. I know I literally moved to New York City in
Tough time.
October 2008 to work in finance in New York City. Great time to be, getting that started. And then we survived that, get through that, only to, start raising kids during a pandemic. Can we get a break here? So, two major historical once-in-a-lifetime events happening. And this is what we've had to navigate. It doesn't make us any more special than other generations. It's just very specific to how we manage our lives and our financial lives during these times.
And to what extent do your clientele actually represent that demographic?
I would tell you 80% are between the ages of 28 to 50. So with that average being right around 40, 42.
I think people know you guys from social media, like
That's fair.
the jokes on Twitter.
Sure.
How much of customer acquisition comes from social media?
So I like to think of it as one piece of the overall puzzle. Here we're doing, very traditional mainstream financial media, and you pair that with social media. It's never one thing.
Are you calling us traditional?
No, I'm calling you awesome.
Okay, just checking.
We need you. And we need all of these.
I'm just kidding.
Yeah, I know, but we need all of these
Yeah.
tools to create, a robust way to market in the internet era, right? And the attention economy that we're in.
Well, one of the things I was thinking, and it was funny, people have come up to me about truth in today's society and just with the political environment and just there's so much content even when it comes to business advice. And how do you make sure that what you're putting out there, you're careful about it, there's transparency, because there's a lot of information that's out there that is not good.
Yeah. Heather can talk to that in terms of, we talk about financial influencers all the time and those who are licensed and those who aren't. You're getting more information on the Reddits and the TikToks. And you and I look at those videos and that content all the time, and we have opinions around that.
I think it's very important that you don't end up on the extreme ends of the scale, right? When we talk, we try and tell people, look, there isn't one right way for everyone. So I think you have to be cautious when you see, let's say, a finfluencer online who says, everyone should always do this, or you should never
extremes.
Be in a position to do that. That's
this is the only product
try.
for you. They're trying to sell you that product right here. And I know a lot of financial creators that are so hardworking. It is tough to do this, and a lot of respect to them. But when you get into those extremes, or you're pushing products, or there are no guardrails whatsoever, it can get dangerous here. And there's just not enough of the hybrid. You can be both. You can be a professional and a content creator. You can do all of these things, but people tend to just stick to their corners, I think.
So if we think about your clients, it's different in the sense of, we're oftentimes talking to wealth managers who have, 5, 10, $100 billion in assets under management. I mean, much bigger than where you guys are right now. So you're at a different end of the spectrum, and your clientele represent that. Yeah. I think people might say, okay, a lot of these folks are Henrys, right? High income, not yet rich, right?
Yeah,
whatever the acronym is.
Yeah.
How do you keep them when they do become rich?
Yeah, I think we have less of that problem when you're there with somebody in the days that they're grinding it out and establishing themselves. You're likely to have a stickier relationship, a more loyal relationship. You meet someone after they've made their money, I think you have a weaker relationship. You were not there for the time.
Right.
You're as good as your last transaction. That is the worst place you want to be as a wealth manager, as good as your last transaction, as someone who's been at the core of their growth and having that kind of relationship. So, by design, investing in our clients at a time when we were in our mid to late 20s, that's how we keep them for generations. Their children are our clients. They are also 9 years old, but they're our clients, and they will be. And that can then transcend down, and we don't have to worry about maybe some of our colleagues that haven't been paying attention to the next generation. They have 70, 80-year-old clients. They have issues with retaining the money because they didn't even bring their partner to the table.
Yeah.
And like these gender tropes, a lot of why we've written a book about love and money is to solve that problem, bring both partners to the table, and that's very characteristic of the type of clients that we serve.
You have a new book coming out too, I think in October, Money Together. But I want to ask you about the quarterly check-ins. I do think this is
money dates.
Yeah, tell us about these money dates in terms of what you guys do in terms of your own financial planning.
Yeah.
Well, for us, we try and do something that we could look forward to. So Doug and I know what we like to do, right? We like to go for walks. Mm-hmm. Maybe that's like a leftover thing from COVID and like pushing strollers around the neighborhood.
We like drinks too.
We like cocktails too. So like we'll go out for a nice cocktail, or we will go for a walk, or we'll go play tennis and be sure to leave 20 minutes on the back end to have a good conversation after we've like sweated out a little bit. I think the most important thing with money dates is to do what you enjoy, so this doesn't become something that is a chore, something that you dread. You want to incorporate the money conversation into your life.
But does it always go well?
No.
Of course not. You're talking about actual decisions you need to make that involve risk and charting the course of your life
Different
moving forward.
priorities sometimes?
Of course.
How about this? To Heather's point, start the conversations with the wins and what you did right. You're going to have a better time getting into it, and then talk about where room for improvement needs to be made. Then be critical. Give yourself a pat on the back and the hard work you're doing before you get into that stuff, so you reduce the probability that you're going to get into some kind of scuffle around something that you don't agree on. And it's very normal to find stuff you don't agree on. If you're agreeing to everything, I'd be a little more concerned about that.
Well, right, and our concept of a money date doesn't just include looking at a net worth table, looking at spending.
Don't start there.
Don't start there. You can talk about childcare. Talk about whether you both feel like your bandwidth, like you have any bandwidth or you don't, or whether you feel totally overwhelmed.
Yeah.
You could talk about goals. You talk about how, like Doug said, the things you've been doing right and the things you could stand to improve upon for the next quarter.
We rather talk about how we're going to get on that trip with the kids during November when the teachers do their convention thing in New Jersey. And we rather, we're going to rally around that conversation because we want to go have that experience with them. And that then dovetails into, okay, let's see how we can afford to do that. What do we have to shift around? All right, let's cancel this babysitter. Let's not do that date with our friends because we much rather, we can do that anytime. You can't create those memories, all the time with your little kids. So those are great ways to engage something where most people are like, here's what you did wrong this month, sweetie. Like, what an awful way to start out. You're not going to do it next quarter.
Right.
And you need 4 quarters in a year. 2 years is only 8 cracks at it. It's not a lot.
It's practical, but it makes an awful lot of sense.
Big
Doug,
time.
we're going to let you go because you got to run to your panel. Good luck with it.
Thank you.
Have
Heather's here
fun.
for you.
Heather, you're not so lucky. You're staying
You're stuck in that.
Good luck, babe.
Good luck with the panel.
Thanks,
we're going to let you go.
Absolutely.
We do want to stay with you, Heather, because you do have this book coming out in October, Money Together, How to Find Fairness in Your Relationship and Become an Unstoppable Financial Team. And I just think it's kind of interesting because I do think a lot of couples do have different priorities, right? And you got to figure it out.
They sure do.
Tell us about this book, though, and what you guys wanted to do with it.
We want to help couples communicate about money better. Bottom line. I think that it's one of the hardest things for couples to talk about because money is not just money, right? We tether our beliefs and our behaviors around money. They come along with a host of feelings about trust, freedom, power, independence. So when you're actually getting in a little spat, week to week on spending, that's not really what you're talking about. There might be feelings beneath that. There could be a spouse who doesn't feel like all of their invisible work is being seen. So what we really hope to do with this book is to have the conversations that aren't being had. We want to really uncover those, deeper power dynamics over money in your relationship and help couples find a way to talk about it in hopes that we can level that playing field and really bring more equity into relationships.
Well, when the book comes out, you got to join us in the studio back in New York. Heather Bonaparte, Director of Business and Legal Affairs for Bonafide Wealth. She joins us on site here in Huntington Beach, California for Future Proof. Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
All right, folks, we're going to talk a little bit about the world of private credit. It has ballooned, by the way, to about $1.7 trillion in size in just a matter of years. There's a lot of issues going on in this environment. Most loans held in private credit funds mature within 5 to 7 years. It's a time frame for when investors should start seeing many more returns, but many vehicles formed 8 years ago still lagging on a closely watched metric known as distribution to paid-in capital, which measures how much investors have received compared to what they put in originally. We're curious what our next guest has to say. He is a player in the private credit world. Mark Gatto is co-founder, co-president, and co-CEO of Scion Investments, which specializes in alternative assets, in particular private credit or private debt. The firm has about $10 billion in assets under management. Mark is also director, co-CEO, and investment allocation committee member of the Scion Ares Diversified Credit Fund. So you know a little bit about credit. How are you? Tell us a little bit about your fund and the strategy right now.
I'm doing well. Thank you for having me today. So our platform is really focused on providing alternative investment solutions to private wealth investors, individual investors. So where a lot of the private firms, private asset managers that deal in private credit and other strategies focus on institutional clients, our focus is on individuals, and we distribute our products through the wealth channel, the RIAs, the wirehouses, independent broker dealers. We currently have 3 products that we're very proud of. One is our publicly listed BDC, which is called Scion Investment Corp. And that's a strategy where we focus on the U.S. middle market, providing direct lending, private loans to U.S. middle market companies. We also have a diversified credit fund, and that's a partnership that we have with Ares Management, one of the world's largest global investors, top tier in credit. And that fund is structured as an interval fund. And we have close to $8 billion of AUM in that product.
So that's the big one.
That's the big one. That's the big one. And then we just recently launched, it's not private credit, but it's private assets, private markets. We launched an interval fund that focuses on infrastructure investing. So we are all in on private markets, but we're also very focused on the right structures for the individual investor. The stat that you mentioned earlier about capital effectively being locked up, right? That's not what we do. We really focus on strategies that provide appropriate liquidity, as I like to call it, appropriate liquidity to individual investors. So the interval fund structure, the BDC structure, what we do is we are giving dividends, we're giving distributions on a regular basis, and that's something we pride ourselves in is consistent, stable dividends that are necessary, I think, for the retail investor.
Which you really lay out on your website.
Yes, absolutely. So when you think about investing in one of our products, you're going to see hopefully a high single-digit distribution yield every year. So you're getting your capital back. Where traditional private credit was done in a GP, LP drawdown structure, and your capital could be locked up for a long time. And because of these structures, we're seeing this strong demand by registered investment advisors, other financial advisors that deal with individuals. And that's what these products really are doing. They're opening the gate, right? They're providing the access that individuals have never had.
The growth of private credit over the last few years has coincided with a pretty strong economy. And we're now starting to see some cracks form. We saw the revisions downward with the labor numbers that we got today. Jamie Dimon telling CNBC today that the economy is, quote, weakening. He said, whether that is on the way to recession or just weakening, I don't know. What happens to private credit in an environment that's weakening, in an economy that's weakening?
Your strategy specifically.
So I think that obviously there'll be some winners and losers, but I don't think the market craters. So it's really important to tie yourself to a good manager, someone that is very experienced in the industry, knows how to underwrite, knows how to be selective, can generate opportunities that make sense for the investor.
Well, because the concern is that the folks who have been lent money will not be able to pay that money back.
Yeah, and that's been a theme that's going on for some time now, right? We've been having this conversation for a long time, and people got really spooked when interest rates spiked, and how are these companies going to afford their debt payments? And the reality is that they have been able to do it. And I think a lot of the U.S. middle market is very resilient. And when you think about the assets that we focus on in our publicly traded BDC, we're looking at companies that are between $25 and $75 million of EBITDA, which we believe is the true middle market. What's happening now is there's a real convergence of the syndicated loan market where banks typically played, right, and the upper middle market. So private investment managers, private credit managers are doing those deals that banks used to, and I think that's where you're going to see some more issues.
Why are the banks not doing loans to those companies? Or conversely, why are those companies not going to a traditional bank for that loan?
Sure. So effectively, banks have been regulated out of the business, right? They're not focused on it. They abandoned the business after the great financial crisis. They let all of their deal team go, all of their portfolio managers go. They were gobbled up or formed their own private asset management firms. So you don't see the big banks doing these types of deals because they just don't have the expertise anymore. What they do is they get involved, I think, in the market more synthetically by lending to firms like us where they can be on a more senior secured position. And what we're seeing is these larger private institutional asset managers, they're getting so big where they are now the bank. The difference is that the investment committee, the people making decisions there, are able to do it more efficiently, provide more certainty, be more flexible than, say, a traditional money center bank.
We're talking with Mark Gatto. He is co-founder, co-president, and co-CEO of Scion Investments. Mark, what's a deal you will do in the private credit space? What's a deal you will not do? Because, and how much transparency are you feeling like you're getting on these deals?
So we feel like we get a lot of good information. Obviously, we're very diligent about doing our underwriting and understanding what we're getting ourselves into. I think every investment warrants merit if it meets some of our baseline criteria, right? So we're looking at companies that have earnings, right? So that's first and foremost. So $25 to $75 million EBITDA is our sweet spot, and then we want to really focus on. Are they relevant in their industry? Are they a leader in their industry? Do they have a good management team? Is there a reason for them to exist? So we're gonna focus on those things to determine whether or not we want to do the deal. On a high level, we're not doing a lot of stuff that's very cyclical in the BDC and even in our interval fund diversified credit. We're not doing cyclical industries. We're probably staying clear of retail in many instances. Not to say that we won't do either of those deals.
Right.
It's just not going to be a major portion of what we do.
Give us an idea of a deal you recently did. And I'm curious about like the infrastructure play right now, if that's a big part of it, or energy, like what you're seeing.
Yeah, so on the infrastructure side, which is a little bit different because we're actually focused more on the equity of these infrastructure deals. So, but they do have a lot of characteristics that credit assets have. I think it kind of falls in between pure credit and private equity, if you will, right? Because when we're talking about infrastructure, we're talking about stable revenue that's being generated by these assets, that's predictable. So it has that element, but there is some sort of growth story to that. And if you look at our infrastructure fund, we're doing deals like the M25 in London. So roads, bridges, we have terminals at LaGuardia, terminals at JFK. We're in AI and data storage. So we really run a diversified strategy, and that is a theme throughout all of our products. We want to be diversified, and we think that's probably the most important thing for us as a manager, and we think for investors is to be diversified. If you look at our BDC, we have 160 different names in there. If you look at our interval fund, the Cyan Ares Diversified Credit Fund, we have over 700 names in there. So you're really getting granular, you're really getting diversified. So no one deal is going to make a difference, and no group of deals is going to make a difference. And we're doing that same thing with infrastructure. We want to be highly diversified.
Is there political risk with the infrastructure fund in the sense that you have an administration right now that wants to punish different states and cities for not getting in line, essentially? We see that with the Trump administration and with the MTA, for example, and tolling, congestion tolling. Is that a risk?
So we don't view it as a risk because of our diversification, because we are investing in different areas of infrastructure. We're not a clean energy play. We're not a fossil fuel play. We don't believe that there's much political risk in terms of our strategy. And then if you look at the industry as a whole, the market as a whole, there's such a high demand for infrastructure assets. There's such a need to spend capital to improve our infrastructure assets, not only here in the United States, but globally. It's a multi-trillion-dollar opportunity. We don't think that the current administration or new administration is going to sort of move the needle one way or the other, especially if you're diversified. And again, I go back to that theme. It's really important at Cyan Investments. We preach it to our advisors and clients that's where you need to be, not only within alternatives, but across the entire spectrum.
Just got 30 seconds. How would you describe the environment? Like in a word, a couple of words.
I think the word that describes the environment is uncertain. It's been that way for a while. It's going to be that way for a long time. Information moves too quickly. The global economies are too interconnected. There's always a news story that's going to give you some sort of angst that's going to make you think things are uncertain. So that's why we fall back to diversification, and we like alternatives for our clients, our advisors, because we think we stabilize some of that uncertainty and volatility in the marketplace.
We know you're based on the West Coast, but we hope we can attract you back to our New York studio.
We're headquartered in New York, so anytime I'm there often, anytime you would like to have me on as a guest, it'd be my pleasure.
We would love it. Mark Gatto, he's co-founder, co-president, and co-CEO of Cyan Investments.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.